Good evening, ladies and gentlemen, and a very, very warm welcome to this Sanlam Private Wealth exclusive webinar. At the end of the presentation, there will be an opportunity for you to ask questions that I will pose to David, and the entire investment team is online should they be needed or called upon to answer those questions. I hope you will enjoy the session with us, and should you have any further questions beyond that, you're welcome to engage with your portfolio manager. With that, I hand over to David Lurkey.
Thank you, Thiessen. Good evening, everyone. Thank you for taking the time to join us this evening. I think we'll start today just talking a little bit quickly about philosophy and performance. Many of you will have seen this slide before, and I can assure you, you will see this slide again. This is our investment philosophy. A reminder to all our clients that our investment philosophy starts with price. That's the most important thing. And really, we deal with the difference between the price of an asset and the intrinsic value, and that really tells us whether we want to be buying or selling. How do we know what that intrinsic value is, whether we want to buy or sell? That's the central piece, that's perspective. That's really what we're going to focus on more today when I touch on quality within businesses. That's the part that certainly gets me the most excited about the job. And then the third piece is pattern. We know that markets are run by human beings. Patterns do repeat over time, and we certainly believe that history can be something of a guide to us when we think about how we invest our clients' money. Always like to think, where is our edge? Where can we do better than the market? And really, there's kind of four pieces. The first is long-term thinking. We're very lucky at Sanlam Private Wealth that our client base is appropriate for the kind of long-term thinking that we like to do. When we think long-term, we are then able to take advantage of opportunities that often arise because much of the rest of the market thinks more short-term. The second piece of edge is in the detailed work. That's part of what I'll show you a bit later, and it's really about unearthing quality. The third piece, understanding cycles. We think we've got a fantastic edge, certainly relative to global investors in understanding cycles. Just really that comes from being part of a South African environment and therefore a more cyclical economy. And then finally, putting it all together, you can have all the fantastic ideas and think long-term and all the rest of it, but you need to have the stomach to think in a contrarian manner to actually execute on those ideas. So if we have a look at performance, this is the South African equity portfolio. That's your black line there. The middle orange line is the South African stock market, and then the blue line there is our average competitor. This goes back until the beginning of our South African equity portfolio at the end of 2005. In the 19 years since then, we have just about managed to increase your money by a factor of 10. Over the same 19-year period, had your money just been in the market, it would have been up around about 8.5 times, and had it been with our average competitor, it would have been up around 5.7 times. I think what's more important for most of our clients is that over that period, your money has beaten inflation by a little bit more than 7% per year. Our average competitor has only beaten inflation by around 4% a year, and you can see on the screen there just how impressively that compounds over time. If we look maybe a little bit shorter term, just the last 10 years, you can see sort of how the different portfolios have done. Interestingly, the black and the blue line, which are our local equity portfolio, and our worldwide equity portfolio, which of course has round about 30 to 40% in offshore equities over the years. You can see over the last 10 years, we've almost increased your money by 2.5 times. Our average competitor has increased their clients' money by around about 1.9 times over that period. And I think we're very proud to be able to say that over the last 10 years, we are ahead of more than 80% of our competitors. If I then just take you very quickly having a look at our house view portfolio at a very high level, how do we think about it? This chart, I think, really gives it to you in a nutshell. Firstly, the black bits, if you think about our portfolio, the way we look at it, we expect earnings growth within the businesses in our South African equity portfolio to be around about 16% per year for the next 3 years. It's a little bit ahead of the market, which is we think will do about 15% earnings growth. At the same time, you are paying a lower price for that earnings growth relative to the market as a whole. If I just then show you sort of a little bit more short term, broadly asset class returns over the last 3 years, up until the end of September, what you can see, South African shares have given you just less than 15% per year. Global stocks have given you around about 14% a year in rands over the last 3 years. You can see their local bonds about 11%, global bonds only around about 1%. I think what we can be very happy with is that the South African market has delivered, I think, around about 24% over the last 12 months in rands, and that equates to nearly 30% in dollars over that same period. Also worth noting that sort of 14-15% you've gotten out of stocks, whether it's local or global, over the last 3 years, that's given you sort of 8 to 9% ahead of inflation over the last while. So certainly very happy to be able to say that our clients' money is worth quite a lot more in real terms today than it was 3 years ago. Just going to switch gears now. We're going to talk about the global macroeconomic environment for a little bit. And really, there's 3 things I'd like you to take away from our discussion today. I think the first is that despite all the predictions from economists around the world over the last sort of nearly 2 years, it does appear that that US economy will get the soft landing, as in getting inflation down back to normal levels, around about 2.5%, without having a recession. What that does is it creates quite a nice positive backdrop for global equities, and should, quite importantly for us in South Africa, provide something of a tailwind for emerging markets. I would just caution, we mustn't become too complacent about inflation risks. I'll explain some more of that later, but also be aware of where global assets are priced. I'm going to ignore this slide. I think it's maybe a little bit complex, but really the point I want to make is that when we've had soft landings in the past, as you can see we did in the 90s, and also in the mid-80s, it's typically been quite good for markets. That's part of why we've seen markets do so well this year. Very interesting to us is how monetary policy has worked much more slowly in the United States than the rest of the world. And really, the answer is kind of shown on screen here, where on the left-hand side, you can see that corporates have funded themselves quite long with debt. So more than a third of their corporate debt in America matures in more than 10 years from now. By contrast, if you look at the US government itself, a third of their debt matures within a year. They've funded themselves very short. The difference, of course, is corporates can't do that because they can't print money. The government can, and that's why we've got quite a lot of debt in governments around the world, but we don't need to be too worried about that. We need to be a little concerned over the longer term. What I'm showing you here is really just the US budget deficit as a percentage of GDP. You can see we're sitting at around about 7.2% deficit right now. That's high relative to history, and particularly it's high relative to the economic situation that we sit in at the moment, where actually that economy is doing very well. I think the data out recently suggests around about 2.8 or 2.9% GDP growth for the states in the third quarter. What we do know for sure, though, is they cannot continue to run these kind of 7% budget deficits indefinitely. The problem is it's politically quite difficult to do that. So really the way out of the hole is through growth. What we're seeing is actually some early signs of the credit cycle and other things bottoming, and that suggests to us we may be at the start of a fresh round of positive economic cycle. We're quite excited by that. This is just one indication. We have a lot more that we're not going to really bore you with today, but I would say that we are seeing restocking in a lot of industries, and that is typically quite a good sign for commodities. And another thing that's quite encouraging when we look forward to 2025 for the consumer around the world in general is that we do expect there to be a little bit of a surplus in oil supply. Why is that relevant? Because oil is the foundation for energy for the global economy. If that price does come down a little bit, it certainly is generally quite helpful for the economic environment, and that should help consumer sentiment broadly. I'll touch on that in a little bit more detail later around South Africa. We now come to the very exciting election we have next week. It looks very close. The bookies are certainly telling you that the odds are in favor of a Trump victory slightly, relative to Kamala Harris and the Democrats retaining power. I think what is quite important for the whole world is that in this scenario, we hopefully get a split Congress. So we don't have one party controlling the presidency, the Senate, and the Congress across the states. We think already the market has mostly priced in a Trump victory, so there'll be more dramatic action in the markets, we think, if Kamala Harris wins the election. But just worth noting for our clients that if we get a Trump victory, it probably favors within equity markets, energy, financial, healthcare stocks, and small cap stocks as well in the States. It will also probably be quite good for the US dollar. By contrast, if Kamala Harris wins the presidency, then you'll probably see consumer discretionary stocks and consumer staples outperform, and equally she would probably be a bit more negative for things like energy and financials, but probably better for US bonds. One thing worth noting, you know, politicians always make lots of promises. Some can be delivered quickly, some not. The ones that can be delivered quite quickly, in all likelihood, will be around trade in the States, where the president has quite a bit of discretion. So if we do get a Trump victory, expect tariffs to be among the first things that change. That's probably in due course, we think, negative for US growth, but there's a bit of a lag there, maybe a year or two, that it'll probably be quite positive. At the same time, we would expect, under that scenario, to see some increased stimulus coming out of China. Interesting chart here. This is a very, very short-term thinking. We actually saw markets down quite a bit today. What it shows you is that in the past, when we've had tight elections, in the lead up to the election, 3 weeks or so before the election, we've typically seen US market pull back a little bit. We are seeing that today. Probably expect that for the next couple of days. But I think more important is that within a few weeks after the election, the uncertainty then comes out of the market. Markets can then look forward, and we would expect markets to probably perform relatively strongly into the rest of the year. Always interesting to think about gold, particularly in light of that growing US or that high US budget deficit and the growing level of US debt that we have. Gold has, of course, in recent weeks reached new all-time highs in real terms. Obviously, it's a long way ahead in nominal terms. Interesting for us, though, gold is also high on a relative basis versus oil. It's high versus copper, and it is high versus cost curve support, which is maybe a little bit less relevant than gold. But really, almost all gold miners are able to mine gold for less than $2,000 an ounce. We're pricing quite a lot more than that. Why then haven't we sold out of our gold holdings in our balanced portfolios or out of our gold shares in our equity portfolios? It's because we think in some ways the world has changed a bit since the Ukraine-Russia war started. Because around that time, the US froze Russian dollar assets, and with that, we think that has frightened certain emerging market governments and therefore made them want to rather hold gold as their national reserves rather than US dollars. If we just then jump ahead to the South African macro situation, Thiessen touched on it a little bit earlier. I think we can be very happy that we have a government of national unity. Really, at the moment, what that points to is the middle road for our South African economy. So we're looking for GDP, not quite yet, but probably in 2026, 2027, hopefully getting up to around about 3%. Next year, we'd certainly be looking for more than 2% GDP growth, hopefully 2.5%. Remember that load shedding, it's wonderful. We've had power every day for 7 months now. It's a bit of a strange thing to be saying, but remember that that was quite a material drag on economic activity in South Africa last year and back in 2022, as were the issues at the ports. And we're now seeing stable electricity. The ports are starting to improve off a low base, but all of that will help our GDP growth in the coming months and years. I think I might also just take a minute here to touch on yesterday's mini budget. Don't want to go into too much detail, but for us, very important parts of that mini budget were that the primary budget surplus is still seen as rising. So that's when you exclude interest payments, we expect a surplus, so we can start to pay down debt in due course. And the Reserve Bank and the Treasury is looking for debt to GDP ratio to peak next year in the 2026 financial year, and then to come down very slightly after that. So peaking at around 75.5%, coming back down to around 75% in 2027 financial year. What we think is quite exciting, though, is this budget was based on what we think are far too conservative a set of assumptions from the government. So they're only looking for sort of 1.5% to 2% GDP growth over the next few years. We think it's going to be quite a lot better than that next year and the year after. So with that, we're very happy about the level of conservatism in the budget, and we do think that leaves a bit of wiggle room for South Africa to do better. And that maybe brings me to my next thought process here, which is that we view South Africa at the moment as in the early stages of a virtuous cycle. As Thiessen touched on earlier, the petrol price is down a bit, the currency is a bit stronger. We've seen inflation come down a bit, and we saw the first rate cut in our country last month. All of that has helped to improve confidence, and at the same time, we have the combination of that government of national unity, better electricity availability, and Transnet effectiveness. And all of these things kind of feed off each other. They will, of course, play through with a bit of a lag, but we do think we're in the early stages of such a virtuous cycle. Consumption will maybe play through with a little bit of a lag. We'd think, though, that the upcoming festive season will really, for us, be a key indicator of whether the reality of our economy has improved in line with our perceptions. One maybe last thing that we take note of here is South African economy has grown slowly over the last decade and more. So we think that most South African businesses are actually running very lean right now. So if you get this improving GDP that we expect, you should see wonderfully positive operating leverage come through where corporate profits grow ahead of nominal GDP, which certainly should be quite positive for our stock market. Maybe just a word on the rand. On a sort of through the cycle adjusted purchasing power parity basis, we think the rand is worth less than 16 rand to the dollar. Do we think it's going to get there immediately? No. Commodity prices aren't quite where we'd like them to be. But we do think that if we continue on the current good political path, and that if confidence improves as we expect, we should get that rand back down to 17 rand to the dollar in the early parts of next year. So that's quite positive for us. That then leads into how we think about South African government bonds. So if we just take a 10-year government bond in South Africa, the current yield on that is around about 10.5%. So that's roughly inflation plus 6%. That's a very encouraging real return that you can get out of South African bonds. We also think you might get yields coming down a little bit over the next 3 years. If in 3 years' time government bonds are yielding 9%, you should get around about 13% a year from SA bonds. If the bonds only drop down to about 10%, you should get a little bit more than 11% per year over the next 3 years from our local bonds. If I then move on to markets and a little bit around valuations, when we look at our local stock market, our market's around about 10% cheap versus its historic average. And remember, we're moving potentially towards a higher growth period than we've had in the last decade or so. So we would hope under that scenario that we'd get our market moving above average in terms of its rating. By contrast, if we look at global markets, this is the S&P 500, more just America, but there you're sitting at around about a 22 times forward-looking price to earnings multiple. That's quite a lot higher than its average. So there, although the economic environment we think is quite encouraging, we do note that markets have already really priced much of that in. So from here, We think the US market will struggle a touch to deliver fantastic returns. We think back to the South African market, if it delivers back to expectations and we sort of get a little bit ahead of our average multiple we've seen over the last decade or so, we think you can probably get 13 to 14% per year out of the South African market. So call that 8 to 9% above inflation, which we think is quite attractive returns in real terms. By contrast, the US market, it is quite expensive, as I mentioned. So if it returns to historic average levels, then your returns don't look particularly exciting. Just note these returns are in dollars. The previous chart I was talking in rands. For you to get your kind of 6 to 8% returns out of that US market, you'll have to see the current rating maintained. That seems feasible right now, but you are kind of fighting against history there a little bit. That brings me now to speaking about quality. I just want to take a few minutes to explain to our clients our thought process around quality. And we, at the moment, have a 30-factor model that assesses the quality that we see in various different businesses. But I'm not going to take you through all 30 things. I think everyone would die of boredom. I'll just take you through sort of 4 broad buckets. So the first third or thereabouts, we think about sustainable competitive advantage. Most important thing there is does a business have a network effect where the more customers that business has, the more customers want to be on that network. And the simplest example there, of course, is something like a Facebook. The second bucket we think about is industry attractiveness. That's where we look at things like customer power, supplier power, the level of competition in a market. And that's also where we would factor in things like regulatory risk relating to any given business. The next piece and the largest piece there is the growth factors. That's where we, amongst other things, like to have a look at what might a company and an industry look like a decade from now. How do we expect businesses and industries to change over that decade? We think that's a very important component of deciding which businesses we would like to be in. And then the final piece there is just looking at management of a business, the culture within a business, and essentially asking ourselves the question, how good is any given business at what it does? You can think maybe in your own mind, which of the banks or which of the retailers in your mind might be the best at what they do. So when we take all of those pieces, I don't want to get into too much detail here, we get quality ranking scores for our local shares. So in this instance, you want to have a lower score. So you see in the top there, we'd have businesses like Prosus, like Clicks, Richmond, Dis-Chem, a Bidcorp, something like a Capitec. Those we would say are among the highest quality businesses on the South African market. At the bottom end of this scale, just note this scale is only a certain number of our businesses. There's a lot of small caps that would be much lower in quality than this. But at the lower end of this scale would be businesses maybe like a Sasol or a Life Healthcare, maybe a Tiger Brands, something like that, where they don't have the same level of sustainable competitive advantage. We do also realize, though, that you need to have second-level thinking to gain additional edge here. We have to ask ourselves, how will this quality perception change over time? And that really brings me to the next thought process here. What we're comparing is the market, is how much the market is paying for the earnings 2 years out in a variety of companies here relative to our quality ranking. And what you want to do is really buy the stocks that are below the line here and own less of the stocks that are above the line here. So you might notice sort of on the left-hand side there, something like a Prosus, right on the left because we think it's a fantastic quality business, and quite a long way below the line. That's why that is the largest holding in our local portfolios. Equally, something like Clicks, fantastic quality business, no doubt, but the price is wrong for us. We think the price there is far too high, even though it is a great quality business. We think the market is paying for even more growth than that business should be able to deliver for us. Equally, maybe you look at something like a Standard Bank, the SBK is sort of lowish towards the left. you can see that is on a similar kind of price that you're paying for Standard Bank as you might for something like a Nedbank or an MTN, but we think Standard Bank's far higher quality than those other two names. That's why we've got a lot of Standard Bank in our client portfolios. Do note that we look at miners quite differently. We think mining businesses are very different, or should be assessed very differently when it comes to quality, because they really are all about the commodity cycle. Within mining, though, what we do is we score our miners on a variety of quality metrics, and really, if you have a look at the left-hand side of the chart where those quality scores are better, you'll see the miners that we own in our client portfolios: BHP, Glencore, Anglo American. I would also suggest that in 18 months' time or so, when Anglo's has finished its restructuring and adjusted the shape of its portfolio, that should even further move up that quality ranking there. So let's maybe take a step into individual businesses and just sort of try to illustrate the point with a couple of businesses that hopefully a lot of you will understand, and businesses where you interact with their products on a daily basis. So we ask ourselves, what makes Microsoft a great quality business? I've touched on network effects already, but the thing is, if you want to send an email, it's a whole lot easier if you're doing it via a Microsoft environment, because everybody else in your organization probably already has that. Equally, think about a business and the switching costs associated. I'm sure a number of our clients on the call will own their own businesses. Think about the switching cost of moving away from Microsoft. If you told all of your staff, no, we're going to move away from the entire Microsoft suite, and we're now going to work on a variety of Linux-based systems, the lost productivity would be far more painful than any benefit you might gain from not having to pay for those Microsoft products. So that high switching cost, we think, is a fantastic source of sustainable competitive advantage for a business like Microsoft. The next piece there, of course, would be superior economies of scale. That's just because they're so large, they can really afford to spend so much on developing fresh product because they can spread it over a very large number of potential customers. And then the last piece really is we think they're very good at what they do, and we think they're in an industry that should grow ahead of global GDP. And I think that's quite clearly illustrated by their results that came out last night, where they showed that their cloud business, within that, the Azure business, that's grown by north of 30% year on year. Fantastic growth component within Microsoft there. And of course, if you put that all together, if you want one simple number, you can see this business delivers a return on equity of around about 37%, which of course is far higher than its cost of equity. Another business that really we think is a great business, a little bit different to Microsoft in where its competitive advantages sit, is Visa. And again, hopefully, by using an example here that we all touch most days, can help illustrate the point. For us, the first point on Visa is that we think it is really your perfect inflation and GDP pass-through business. You saw it during COVID, inflation rose, and it's wonderful for Visa because they take a percentage of whatever people spend around the world. On top of that, they own the payment rails that are accepted everywhere. Into every bank, into every financial system around the world, Visa is accepted. They've got phenomenal economies of scale there. And if anybody else wants to compete with them, that alternative would have to get their own payment rails integrated into the system, which of course would take a long time, and there's always the question of trust. You can see this business delivers a ROE of around about 49%. These are two of our larger holdings on our global portfolios. I'll touch on one more here, talking around about semiconductors. And if you think back to 2021 and the difficulty of buying a car, buying any sort of electronic equipment, what happened there? Global semiconductors, there was a shortage of them. And it was very difficult for the entire world to function without semiconductors. If we have a look here, what we're showing you is the two semiconductor stocks we hold in our global portfolios. First is Taiwan Semiconductor, that's the TSMC on the left of the chart there, and then in the middle, a business called Applied Materials. what you can see is those two businesses are trading at a very similar multiple of next year's profits to the broader global market in the MSCI World Index. At the same time, though, we do see them delivering much higher growth than the MSCI World Index over time. You might question and say, well, why aren't we owning something like an NVIDIA? The reason is because you're paying 37 times next year's earnings for NVIDIA that are growing at sort of low 20s. You're only paying 20 times next year's earnings for Taiwan Semiconductor that's growing earnings at around about 16% a year for the next 3 years. That's really why we would own the different one there. And you have to balance out your expectations of growth relative to how much you're having to pay for that growth. If I touch on Taiwan Semiconductor and what makes this business a high-quality business, in our opinion, the first there is around about that sustainable competitive advantage. Taiwan Semiconductor now has just about a global monopoly on leading-edge sort of 3 and 5 nanometer silicon chips. So they have a fantastic barrier to entry there that really gets perpetuated by their size because they have more and more money available for reinvesting into research and development and building new factories. That helps them to really be a very important part of the global economy. Do remember this is a highly, highly specialized industry. Why we like the industry from an investment perspective is because it's been growing so well for so many years that the companies within the industry are actually far more interested in being the very best at what they do rather than competing excessively with one another. So that does improve that competitive environment there. We are fully aware, of course, that Taiwan Semiconductor is based in Taiwan. There's obviously geopolitical risk there. And that's why we'll always keep our position size appropriate here relative to that risk. So without that Taiwan risk, we would have a much larger position size, but then equally, in all likelihood, the price of the same earnings stream in future would be quite a lot higher. If we then just touch on something that obviously is very important to all of our local portfolios, that's a business called Tencent. That's the largest part of Naspers and Prosus. We think this business has among the world's very best network effects. There's more than 1 billion users on their product called WeChat. It's very similar to what we know as WhatsApp in South Africa and around the rest of the Western world. The difference is that we just use WhatsApp to communicate. That WeChat platform has many mini programs embedded within it, and therefore a lot of your online shopping, your payments, your banking in general is actually done via mini programs within that WeChat ecosystem there. And of course, many, many small customers, those customers don't have power over the business to really adjust prices, and we think Tencent is exceptional at what they do. So we do think with that, both the business and the industry should really grow very nicely over the next decade or so. If I just touch on sort of the valuation side of it, you can see here just a way we look at Prosus and Naspers as a whole. We've got the Tencent component, the various other assets within the business, and we think net that this business, for Naspers, we think it's worth around about 5,250 Rand a share. It's around about 25% above the current share price. So we see a fantastic business at a very attractive price, and that's why it is, of course, the largest holding in our portfolios. If I just touch now on another one of our international holdings, a business called Parker Hannifin. This is really an industrial business that's about motion and flow control. And why I've sort of chosen to speak about it a bit tonight is because it has a very different kind of quality. This business doesn't have one or two fantastic things where it is truly world-class and way better than everybody else. It's rather a business with multiple small advantages across many different components of those 30 quality measures that I spoke about earlier. This is really a business that's just very good at what they do. They supply small but vital components to customers across a variety of industries. And we think they have a fantastic skill in redeploying capital to drive growth. And really that's evident if you look at this business over the last 30 years. It's grown relatively consistently at around about 16% a year. Now, if you do 16% a year for 30 years, you get an 85 times return. So your original 1,000 Rand in this business, or $1,000, would now be worth $85,000 30 years later. These are the kind of multi-year compounders that we like to try and find for our clients. I'll end off here with a couple of slides just around Boxer. This is the discount retailer that's coming out of the Pick n Pay stable. We're quite excited. This will be a very interesting new listing in the South African market, one of the first for many years of this kind of size. What is interesting to me, though, is I think most of our client base doesn't understand the Boxer business, because really it is a discounter. And most of our clients wouldn't have actually been inside a Boxer business or inside a Boxer store. Points I just want to make here. Firstly, grocery discounters only have around about 6% market share in South Africa. Those of you who travel a lot to the UK may have picked up the existence of businesses called Aldi and Lidl. Those are really the discounters that have come out of Germany and are now gaining share in the UK. There's a business called Biedronka, which is very, very good at discounting groceries in Poland. That's got a third of that market. Why is that relevant? We think there's a long runway of growth for this Boxer business within South Africa. If you have a look at the pictures here, contrast them to what you might see at your local Woolworths or Spar or ShopRite or Pick n Pay in terms of the variety. You'll see on the shelves here, there's 3 types of cereal. You can get cornflakes, All Bran, or Cocoa Pops, and that's it. And that's really your advantage or your differentiator for a Boxer. Your normal ShopRite or Pick n Pay or Spar, that supermarket will have about 30,000 different items on the shelves. A Boxer has only 3,000 different items on the shelves. What that means is they can run a far more lean and efficient kind of business, and their whole model is to perpetually reinvest any advantage they get into price so that they are perpetually the lowest priced participants in the market. We think this is quite an exciting space to be, particularly in a country like South Africa. We also have a look here just at the kind of store growth. Over the last 2 years, they've grown their store base by around about 20% a year. The next 3 years, we expect them to continue to grow that store base by around about 13% a year. That's ahead of ShopRite, who's the next best, and we think this is a business that if we can get it at the right price, we'd certainly like to own for our clients. The problem always is we're not the only ones that can figure out this is a good business, and so we'll have to see where the pricing sits for the IPO that this business should list, I think, at the end of next month, and we'll have to see where the price is there to decide whether or not we buy in for our clients. That brings me to my conclusion for this evening, and really there's, again, 3 thoughts I'd like to leave you with. First is that we think a US soft landing from an economic perspective, we think that's probable. It's not certain just yet. We do think it's probable. We're also very excited to see South Africa moving in the right direction. And if we continue to get it right and build that flywheel, get that moving more and more, we think we've got quite a long runway for growth in this country if, as a country, we can get it right. A reminder, global markets are expensive, so we do have to make sure that our client portfolios are robust to a whole variety of outcomes, and that's always why we have a lot of quality within our portfolios. I think I'll leave it there for this evening. Thank you. And Thiessen, in amongst all of that, have we got any questions you'd like me to answer?
Yeah, absolutely. Thank you very much, David. You seem quite optimistic, firstly. Is that general, or is it a specific sort of feeling at the moment, given everything that's happening in South Africa?
Look, I think if you're going to invest people's money, you should be optimistic, because over the long term, investing clients' money in stocks has really been very, very effective in terms of growing their money in real terms. But on top of that, I'm extra excited about South Africa. Maybe it's just because we've had a tough time for the last decade or thereabouts. But yeah, I think we're we're in the early stages of building in the right direction. It's not guaranteed, but I'm quite enthusiastic.
Okay, excellent. Thank you. So a couple of questions coming through. Let's kick off with the first one. A big concern for some investors is geopolitical instability. Middle East, Russia, Ukraine, Taiwan, broadly with regards to energy and the impact on inflation, and of course the expected trajectory on the hiking and cutting cycle. What is your house view and how are you positioned?
All right, I might not get to all of those. There's a few different components there. So firstly, on the geopolitical side, if you have a look at an index, and I don't have it in my slides here, but a long-term index over the last 100 years or so of geopolitical stress, we're actually around about normal. I think the media always makes things look more exciting than they are. But yes, we're obviously fully aware of the problems that could arise or could flare up further in the Middle East. Very happy to see that things are starting to simmer down a little bit over the weekend there. But the fact that the world has actually a bit of excess supply of oil right now leaves me relatively calm there. Russia, Ukraine, I hate the fact that it's happening. If I just put my pure sort of business hat on, it seems to be broadly under control there. To then shift to the question around interest rates, we do expect interest rates to continue to come down. We obviously saw the Americans a month or two ago drop their rates by about 50 basis points. The Europeans have dropped theirs. We expect some more to come through the rest of this year. Not quite as much as the market was baking in at the beginning of the year, but that's actually a good thing because it tells you the economy is doing better globally. So I would expect maybe another 25 to 50 basis points worth of cuts globally for sort of developed markets this year, similar in SA, and then maybe another 50, potentially even 100 next year. The better the economy does, the less we're going to see rate cuts, is the thought process. Did I miss something?
No, I think you've covered it. Let's talk a little bit about Donald Trump. You said your thoughts are that the market's effectively baked in a Trump win. So let's assume he does occupy the White House. What are your views on the tariff hike position, and more specifically, I guess, the trade wars that could result?
Right. I think as I did touch on, tariffs is one area where the president has quite a bit of control available quite early in his term. So we think there'll be some pressure there. However, we know politicians typically promise more than they eventually deliver. So hopefully from a global perspective, they don't get too excitable with their tariffs. I think there'll be less than what he's currently talking about. I would also expect us to see some sort of response from China in terms of additional stimulus to that economy to help them out there. But I think really the guys I'm worried about more are the Europeans, because we all think about US and China with trade, but remember, half of the US's imports come from Europe. And I worry Europe might be caught a little bit in the middle here, and the tariffs could hurt them at the same time that they're seeing their own motor industry kind of being squeezed by Chinese electric vehicles. So I worry a little bit about the Europeans. I'm a lot more sanguine about the Americans. And I think China, at the moment, is a cheap market. And I think there's some stimulus has come, and I think a lot more is coming, which is why I think we're actually quite calm about the Chinese market.
Great. You touched on semiconductors in your presentation as well. Your view on AI-driven bets, both locally and offshore?
Thiessen, I think, so I can speak here, but I think maybe I can just hand over to my colleague Christian, who is online, to maybe just take us through a little bit about where semiconductors fit into the AI space. But before I cross to Christian, what I would say is from Microsoft's results last night, 70% of their top 500 corporate customers are now using their Microsoft sort of Gen AI product for businesses. And that's starting to help there. But I'll maybe hand over to Christian to talk a little bit about the semiconductor space more broadly for a minute.
Hi, good evening, everyone. Thanks for that, David. Yeah, just a couple of comments there. I think two companies that we own that David has already touched on that directly benefits from the sort of the rise in artificial intelligence is, of course, Taiwan Semiconductor. and then also Applied Materials. So to put it into context, Applied Materials, they make the equipment that Taiwan Semiconductor uses in their factories to create the chips that gets bought by NVIDIA and many of the other designers that then gets distributed down the value chain to the data centers. So we think with Taiwan Semi and Applied Materials, we cover sort of the picks and shovels of the semiconductor industry, and that way, whoever makes the final product, these guys will be beneficiaries of the AI revolution. Then the second point would be, I think, and that is the big sort of holy grail, is who will be the beneficiaries of the end product that is being developed. And I think that will be across a variety of businesses. To take one company, for example, again, we think a Tencent will be a beneficiary of this, applying AI across the platforms, being more efficient with, for example, advertising, the general way in which their businesses are conducted. So we think many businesses will be beneficiaries of artificial intelligence just in their everyday applications and the way they can save costs. So those are just two examples of where we see AI in our portfolio.
Perfect. Thank you, Christian. Back to you, Dave. Do you have a preference for process or NASPAS?
I think a very slight preference for NASPAS, and the reason is because there's buybacks happening at process level and at NASPAS level, and because NASPAS is trading at a bit of a discount to process, which of course is trading at a discount to its net asset value, you get a little bit extra help there from those buybacks for NASPAS versus process. We think because the underlying businesses and assets are the same, we would expect NASPAS to outperform process by about 1% a year. But it's far more important that you're in one of them or not, as opposed to exactly which one you're going to be.
Perfect. Thank you. Chinese leaders surprised the world recently by announcing a wide-ranging set of stimulus measures. Do you think it'll have the desired effects, and is China still investable?
So to answer the second question first, yes, it is still investable.
Great.
Will it have the desired effects? Not unless they do more than they already have. I think there is quite a bit more to be done. They've sort of laid the groundwork and fixed some of the rules, but now you need to see proper kind of US or American or US or European style stimulus of heavy government spending. You know, something to the order of an extra $1.5, maybe even $2 trillion worth of stimulus into that economy. That needs to come. We would expect some of that to appear before the end of this year. And I think that would then be the catalyst for the next leg up in that Chinese market. But of course, I can't predict what the government there will do, but that's what we suspect will happen.
Excellent. Thank you. I've just got one more for you, I think. You touched on the medium-term budget speech in your presentation as well. SA's GDP or government debt to GDP sort of 75% there or thereabouts, sort of projecting to get to about 77. IMF has suggested a cap of 77. What are your thoughts on that? And do you think that that's something that could be realistically implemented? And what would be the impacts of something like that?
Right. Thiessen, I think, again, I can answer this myself, but maybe it's a chance to just involve my colleague Renier,
Sure.
who is, of course, in charge of asset allocation here. So, Renier, if I can hand over to you to just talk us through your views on South African government debt levels for a minute or so, please.
Yes, good evening, everyone. So, yeah, as Thiessen mentioned, that medium-term budget is guiding towards, a budget or the deficit or the debt levels going up as a percentage of GDP, and it's very high, relatively tolerable levels. And I think government is forced to walk quite a tightrope because the more debt you incur, the more your finance cost gets over time, and it becomes a vicious cycle that you don't want to go into. So I think from our perspective, it's good that the assumptions which have historically been too optimistic has been tapered down. So the government is projecting quite tapered revenue growth and probably linking spending to that lower growth. So as David said, our expectation is that the economic growth will probably end up higher than what the government is budgeting for. Hence, that creates more room for improvement from that perspective. I think you also have to, like with anything, you have to consider risk and rewards when it gets to things like investing in government debt. So it is far from a comfortable situation in terms of where things are going. It's not only South Africa, but really globally. And you have to consider that relative to the return on offer. As we've shown earlier, that the real yield, so that's the inflation-adjusted return that you can get from government bonds in SA, is quite high relative to international standards. And hence, we're quite happy to have exposure to government bonds in our portfolios. Thank you.
Thank you very much, Ranier. We are scheduled to finish at 6. I'm going to squeeze one last one. It's just come through. On the local side, delistings from the JSE seems chronic. How has that impacted the philosophy of Sanlam Private Wealth and our process, given our size?
Yeah, I suppose it seems chronic, but do remember that it's the often smaller, lower quality businesses that have been delisting. There's maybe been one or two taken out, nicer businesses over the years. It is the nature of markets globally. So yes, the JSE, I think, has about half as many companies listed on it today as it did 15 or 20 years ago. But guess what? It's the same for the London exchange, and it's similar in New York, maybe not to quite the same extent. So I wouldn't worry too much. In terms of how it impacts our philosophy, it doesn't. We want to buy our clients the best assets for the right price. In terms of how it impacts our process, it means we've got fewer options in our local market. But of course, the change in regulations means we can think a lot more offshore. So, clients who've been with us for a long time will see that there's a lot larger component of offshore in their portfolios, and I think that probably continues to grow with time, even though at the moment I'm more excited about local equities than global. But I think that continues to grow with time, and we think there are ample opportunities to get good returns for clients in absolute terms, locally and globally.
Perfect. Thank you. On that note, I say to you and your investment team, Christian and Ranier, thank you very much for being here with us this afternoon. And then to you, ladies and gentlemen, I'd like to say a big thank you for joining us firstly and attending the webinar, and of course for your engagement. As always, it is a huge privilege for us to manage your money, and we are very aware of the responsibility that comes with that. Thank you very much, and all the best for the rest of the evening. Thank you.